In 1977, The Clash released the song "We Fought the Law" and the law won. Right now, that's the song I have going in my head over and over again, but with the words "We fought the Fed and the Fed won." It seems like whatever we're doing in the precious metal sector is not helping. The uptrend has been broken, it looks like. And I invited a realist to our conversation here today. I call him a realist because a lot of the predictions he made in our last interview about 3 months ago came true. And he looks at things from a very different perspective. He looks at business cycles and economic cycles and tries to put that into perspective where we're headed. Really, really great conversation. I really enjoyed it. I just rewatched it again from what we spoke about in November. And Henrik, it is great to have you back on the program. Time for some real talk. Good to see you.
Thank you. Good to be back.
Absolutely, yeah, because the market has completely done a 180, at least on the precious metal side, it feels like. Back in November, we were in a bullish uptrend. Gold was moving. In the end, we were up $300. Silver shot up $6 from $18 to $24. Seems like we're losing all the gains right now, and market momentum has completely changed. You want to give us a bit of a synopsis of what happened in the last 3 months and where we're at in the market right now?
Yeah, sure. I mean, in terms of gold, let me just get back to that because I think it makes perfect sense, and I think I actually said that also back then. I haven't rewatched the video, but in terms of the market, we were at that point in a situation where a lot of people were in doubt whether the inflation had topped out, whether the business, everybody was so convinced that we were now descending into the abyss around in November. And what they didn't really account for was that when inflation comes down, the consumer actually starts to, feel that also, just like they feel when inflation moves up. And then the consumer starts to feel a little, better off and will start to, buy more, and consumption will not be just in a decline as we saw because of inflation. So we do see this now, this bounce in some of the PMI numbers that we have, and that was also what I expected. And I think it's going to become even stronger, this bounce. What we also have seen is that liquidity starts to come back into the system. Everybody focuses on the Fed, but there are more central banks in the world. And if you look to the People's Bank of China, they just had the Friday before last, we saw that they injected $92 billion in one day, not in 1 month, but in one day. And we see the Central Bank of Japan is out there and buying, more bonds than they did during the Corona crisis. And we even see the ECB now, also their balance sheet is starting to move up. So what we're seeing actually is the tenseness of the tightening of the financial conditions are, easing at this point. And we have that the economy is not in a recession. Everybody thought we were in a recession back then. I kept saying we're not, because we are simply not there. We do see, and this is where the business cycles are extremely important to understand. This is the leading, coincident, and lagging indicators and how they interact and how they work. Leading indicators have been falling over a cliff, and there is a 100% chance in my book that we're going to see a recession. But it's the timing of the recession, and this is what people get wrong. We're not in a recession yet. We are in Goldilocks phase, inflation coming down, and we have an economy that is rather strong. We saw that also in the NFPs. And that has taken a lot of people by surprise. So people misjudged the situation back then in the economy. And I was saying, I think we're going to see this bounce. I think we are actually at a better place than people think. But still, and this is where it's become so difficult, because I do predict and I do forecast a recession setting off either in Q3 or Q4 of this year.
Interesting. Yeah, no, we're going to talk about some of the indicators that you mentioned, because recession, yes, means a retraction of economic activity, obviously. But I want to talk about the business cycles real quick. I prepared this graphic because I looked it up before our interview as well to sort of understand where we're at, to sort of understand where your head might be at. And do you want to interpret the chart here for us, like the 4 cycles, and where do you think in your opinion we're at right now?
Yeah, sure. So I actually look at this in I do look at similar chart to this, but where I utilize the coincident, lagging, and leading indicators on this, and each of them. So the leading indicators will be in one of the phases, and the coincident will be pulled after the leading indicators, and then the coincident will pull down the lagging indicators. So depending on which an asset class you're looking at, you will see different things. So if we're looking at the leading indicators, we are definitely already in the contraction phase. So the leading indicators will be something like housing permits. It will be something like, it will be actually the stock market is by itself is also, but also M2 and other things. So there will be a consumer sentiment also. So these are some will be in the contraction phase. But it takes time for the coincident. This is a super tanker we have. The economy is not just a speedboat. And the coincident indicators, which tells us where the economy is actually at this point, which means GDP, job numbers, NFPs, and what else are we? They are still in phase 2, in the peak phase. And this is what people have so difficult understanding, because they think, okay, when we see some of these leading indicators dropping to below, zero, below the equilibrium line that I draw up, well, then we're going to be a recession. And then they get confused, because then the economy moves up, and how can that be? And that's because there is this lag in the economy. And the lagging indicators actually are rates. And they follow the coincident business indicators later on. So even though we have rates are up high, which is because they are at the top, they are actually on this phase 2, right at the top, they're at peak. Then you have the coincident, they're like further down, and then the leading ones are in the contraction. So the leading indicators tells us a recession is coming. And in my setup, 120 years of backtracking has showed us every time this signal comes off, we have a recession. So 120 years of data, at least I've got in terms of convincing background for that. So this is how I see it. Leading in contraction, coincident like the job numbers and the like in lower down in the peak in the phase 2, and the lagging is peaking in phase 2.
No, interesting. I appreciate that clarifying, because separating the two indicators as well makes a big difference, as you said, the contradicting indicators there as well. So question now is, like, are we in a bear market? Is this a bear market rally? Is this trap being set right now? Dixie's going up 105 right now, 105.1. S&P is rallying. Like, is that a trap?
No, it's not. It's a trap for the bears, and that's what I have to say. I mean, again, because why would you have a bear market if the economy is not in a recession? I mean, everybody was jumping to the conclusion we have a recession, and then it's just been proven over and over and over, and everything we see. But no, we do not. Actually, we have rather strong job numbers, and we have very strong GDP numbers also coming out. And even if you look at Europe now, they're also bouncing in terms of what we see there. There are, of course, some bad numbers, here and there, but it's not something that is, it's not recessionary. And we had the PMI numbers actually jumping up quite a lot last few weeks ago. So I think people are misjudging that, and then it's just become biting in on itself. Now we have a bear market because inflation has been coming up, and that's why it needs to drop. But actually, if you think about it and you look into it, no, you do not have a setup for a crash. You have a setup for an economy that grows. And how long will that do? I mean, I think we have another 6 to 9 months worth of that. If we look back in time and we do a comparison, which I've done on my live show, with what we saw in 2006 and 2007, well, then we actually have a situation now where we are maybe in January or February of 2007 when you compare job numbers, when you compare rates, when you compare the whole business cycle. So I think people are misinterpreting where we are in the business cycle, and that we have, back in 2007, we would have until December before the recession set in, and you'll have until October before the stock market top is in. And people really do not get that, and they are expecting, the crash, and when it doesn't come, then they'll say, oh, it's because of the bear market rally. But if they look to Europe, they look to Asia, they look to different places, we actually see, in Europe, you have the DAX is up and the CAC is up 30% since October, 30%. I mean, it's and new all-time highs in the FTSE 100 and also in the CAC, or soon, I think, or the DAX also getting close to that. So why would you have an all-time high here in February of 23, if the S&P and the Nasdaq actually topped in November of 21? It does not add up. So people has misinterpreted this. It has been a correction because of inflation. Now inflation comes off or cools off, and then we see stock market actually bouncing up. And I think the bounce is going to be not the bounce, but the rally is going to be rather strong. It's not just going to be a melt up. It's going to be rather a blow off. And I've said that for some time. I appreciate that. But I think the driver will be what you just talked about, the DEUTSCHE. And the DEUTSCHE, I predicted also that we should see this decline down, and we should then see a bounce. I have charts from the live show. And I do see a bounce up to between 105 and 108. Actually, 108, I don't believe too much in. 105 is too low, so 106, 7-ish. And then the decline. And then the decline will drop to around 92 to 94. And that will be a tremendous upside, cause tremendous upside for risk assets, cryptos, and the like.
Well, you mentioned 92, 94 as a sort of a price target for the DEUTSCHE midterm here, as it will correct. Back in November, you mentioned 96, 98. I'm just curious, like, what has changed? Why more negative now than before?
Actually, because it went up higher than I thought. So it went up higher, and that's why it's another. I live in a world of patterns, and in that pattern world, we have a correctional bull market ever since 2008 in the DEUTSCHE. So we had a top back in 2001 and 2002 in the DEUTSCHE, and then it has been crashing down to 2008. In 2008, they started to print money, and everybody thought the dollar would crash. Actually, then it's been in a bull market ever since then. But it's been up and downs, of course. But in that correctional bull market that we have seen ever since 2008, the top from 2001 to 2002 is going to get reached. It didn't really reach it here in just some months ago, but it's going to get there. It's going to get to the 120, 121 on the DEUTSCHE, and that is going to be the deflationary bust. So in my structural world, and this is where it becomes a little difficult without a chart, but I see we have what is called a double zigzag ever since 2008. And that is going to cause a rather big whipsaw kind of back and forth with the DEUTSCHE. So first we had this tremendous bull market. And you may remember also, if you look back in my tweets year and a half and 2 years ago, I was very bullish the dollar. We saw that move up. Now we're going to see that decline into 92, 94. And that's where there is support. This is technical based. And then we're going to see a very, very strong bull market or a very strong move up in the dollar up to around 120.
Wow. Okay, we got to talk about how that correlates to gold, because DEUTSCHE and gold are inversely correlated. When the DEUTSCHE goes up, gold goes down. We're witnessing that right now. DEUTSCHE at 105.1, I believe. Gold barely above 1,800. But in that scenario, when the DEUTSCHE, let's say, crashes to 92, 94, like how do you predict the precious metals to behave?
But this is where people say that it's the inverse correlation with the DEUTSCHE, but it's actually, it's okay strong, but there are definitely things out there that are stronger in terms of correlation. But you have plenty of time. For instance, if you look back in 2018 into 2019, you would see that both the DEUTSCHE and gold was rallying. So it's not that strong. I mean, it's not like you can just say the one or the other. What I think people tend to misunderstand here is that the gold is actually the best inflation gauge we have of all. We tend to misinterpret why gold is moving as it does, but it actually moved up into 2020, August 2020, it moved up strongly. And that was because it predicted the inflation we were going to have in 21 and 22, because people were getting ready for that. Actually, people saw what were coming out of the Corona crisis, and then they got ready for it, and it moved on, in financial institutions. But now it's starting to decline. And that's going to be a bigger decline, and I have had it for a long time, and that pattern has been triggering me. But I don't, we're going to have a 1,200 at least on to the downside here, because we're going to see that the inflation pendulum is simply moving in the opposite direction now. We had this very strong surge of inflation coming out because of the Corona crisis, but now that the inflation is coming down again, gold is going to decline. And 800 to 900 is my lower target, and it's been for a long time. But I see at least 1,200 before we see a bottom.
Yeah, no, those are massive swings, because precious metals move very slowly, and seeing even another 33% decline in the gold price would be a major move, right?
But not if you cannot think, because if you look at it, you actually have exactly that 33 something percent in 2008, from March of 2008 to September of 2008. And that's when inflation starts to come out of the system. We weren't really aware of the financial crisis at that point, but we definitely felt it when we got into October, into 2000, and later in that year into 2009. So this is where gold sniffs up the deflationary and the disinflationary nature of the economy. And that's what you see. And also, you will also see it because when risk asset starts to soar now, why do you want to be defensively positioned there? So if you are, you're sitting and looking at some of small caps are going to shoot up really high, and also cryptos, you will see a repositioning towards that. And that's why also gold can get under pressure. But it's the deflationary impulse that we're going to see is going to be very, very negative on gold, because gold's finest job is to get sold off, to get your liquidity when there's no liquidity to be found. And that's a deflation. That's the, the really, the thing about deflation is that, then liquidity is just being sucked away, and you need liquidity to pay, whatever kind of debt obligations you got. And that's why gold gets sold off. People tend to forget that. It's not just a good hedge against everything. It's bad in the deflationary phases. Why is it then good? Because we always know that the Fed is coming in afterwards, and then they're going to come in with a massive surge of liquidity. And then when gold goes up, and you saw that in 2008, 3% down from March of 28 to October, September. Then Fed came in with their genius of printing money, and gold surged. This is going to be the similar, but in terms of, so we cannot just guide it or, set it off what's happening with the DEUTSCHE. It's more, there's more to the story than that.
Interesting. I appreciate you providing context and color there. The $1,200 price level, like how long do you think gold will be there? Is it like in the oil price where we dip negative for a while, just very short term, or do you think we're going to hover around that level until the Fed steps in, until we get another impulse?
Okay, this is where I first of all, short answer, very shortly. And second will be we gotta, you have to envision what I'm seeing here is that we are in February of 2007. What is ahead of us is the blow off top from the moment we had the Fed started to now let me see if I can remember things correctly here, but when they started to pause actually in mid 2006, remember that in 2006 they paused. And the stock market, and we had a yield inversion also in 2006 already, but still the stock market went up to October of 2007. So this phase we got now, what then happens is after that, we're going to see a sell-off that is going to be rather strong as I see it. When we hit certain levels in various markets, I think we're going to have a very strong sell-off. The Fed is going to stomach that for a certain amount of time. They will pause with the rate hikes or anything like that, but before they start to cut. But I think, and this is where when you look into the real mechanics and the real factors of what the Fed is looking into, which is, for instance, also the housing market, it has been hurt really badly this time around. And something as, and it's very different from what you've seen in earlier recessions. Like it's as bad as it was during the financial crisis, but the rate hikes or the rate increase, the market rate increase has been stronger. And that's why I think when the deflationary bus starts to run, it's with the lag that I spoke of in the earlier, then it's going to get, hit the economy really hard. And that's why I think the Fed is going to come in with vengeance this time. So imagine the Volcker moment just in the opposite direction, where they go in and say, okay, now they look at the deflation in the eyes and they're going to do something about it. And my best perspective will be that it will be early 2024, maybe a little later, depends on where we top in the stock market. But we got this kind of timeline, another year worth of first a bull market in the stocks, then the start of the decline, and then the Fed will panic at some point and see, okay, we got to backstop this 100%. So we are set on for that. And the moment we hear that, that's the moment gold takes off. And it's going to take off for real this time. This not like 2008 was something, but this will be on steroids this time.
Absolutely. You're like in German we say dein Wort in Gottes Gehör, means your word into God's ear. Okay.
Yes. I understand some German. I lived close by the German borders for many years. So
okay, I'm not sure if there's a saying in English for that, but I think it is quite fitting, because it looks like what you're describing now, a lot of secular just headwinds, and we're still in a secular like sort of bull trend sort of for precious metals here. Did I assess that correctly?
Well, I see we have been in a correction ever since 2011. So the decline in 2011, the top was actually there. And if you look closely into it, you actually have a very correctional pattern ever since there. And even the move up into 2020 was a correctional move, which tells me that this is it's a correctional move that we have from 2011 and until now. But the final move down there, the C wave that nobody kind of expects, and nobody expects in many places. I predicted that in other commodities like lumber and the likes, and we see that. And we're also going to see that in oil, which will bring oil down closely to much lower levels. That is going to bring the gold down. The deflationary bust is going to be really hard on gold. And so I think that is a correctional pattern. But if you look at it from 99 and up to 2011, that was a 12-year 12-year bull market. Then we have had actually a 12-year correctional market, and that's actually very often the case. You see that it moves like, with some symmetry to it. And I think when we get to that bottom here in 23, 24, I think we're going to see a massive bull market. And that's why we also have the gold miners report, because we say getting in gold miners at the right time, in the right gold miners at the right levels, and there are some Fibonacci extensions there that just looks absolutely perfect. Well, that could be a tremendous opportunity. So I'm with the gold box to say, and I am a massive gold box. I just say it's not the time yet.
No, patience is, I think, one of the key words, and from our last interview as well. It's just have some more patience. Exactly. I want to talk about base metals real quick as well, because copper is now below $4 a pound, which is a bit surprising to me. But is that just foregoing or sort of foreshadowing the recession you predict in 6 months, or like what is dictating the price trends there? I'm a bit puzzled, to be quite honest.
Actually, I haven't checked it just after this week here, but I still think it's up if you look at 2-3 months back, right? So I think it's just like what you see in the stock market. If you look at the Hang Seng, you look at a lot of the stock markets, you have always the initial move, which will make the bears doubt. And then you'll have the decline where the bears say, okay, now the decline is back. We're back in it's going to come down now with vengeance. And that's what you see in the stock market also. And I think that's also what you see in copper, because copper is actually, we call it Dr. Copper because of it really tells us where we are at in the economy, what the state of the economy is. And I think what the pullback you see now is a second wave of the last fifth wave. So you see just a small rise, and then you saw the pullback, which we're in right now. But the next we're going to see is going to be a rather strong move up higher. So I think we're going to see an all-time high in copper. And the pullback we see right now here is going to be, let's call it transitory, but it's not going to last for long.
Yeah, you're right. July 14th, actually, we bottomed at 315. So.
And that's because you had inflation was in June, the top there, and then it kind of, things are, correlated. And then you see that the consumer starts to come in, the economy picks up in speed again because the consumer starts to consume. Copper is a very strong indicator of where the economy is at. So I think you're going to see copper coming up really strong into this blow-off top that I foresee.
Maybe sort of the last question, maybe for the last 5 minutes, we'll spend a bit on strategies, how to play the current market. You sort of clearly identified some trends, but like, how do you play them? How do you invest into those trends right now, and how do you make money off of it?
Sure. So I'm heavily long equities, both large caps and small caps. I got cryptos. I'm not a big fan of some of these cryptos that I hold, but I have it because it's the liquidity that's coming into the market now, and the FOMO I think I foresee starting to develop will bring this a lot higher. I do not think it's something that has fundamental value, but it's something that will set me off better for into this last phase here. And I right now, we're nowhere near the sentiment that we need to have when we top out on this. And there are so many charts simply just telling me that we are going to see a massive blow off top. So I'm there, but I'm also building a bond portfolio. I got rather large also portfolio of various bonds, German government bonds, and also TLTs. Because I know that we are late cycle, and I know we get, and this is where people want, why don't you just be on the defensive side? Because the chart just speaks and says, okay, there is another move up higher, so I want to have part of this, but I also built a big bond portfolio here. We may even have another high coming to the rates, but with the decline in leading indicators and what I foresee coming into the coincident indicators, I think bonds will be it's a massive buy here. So I'm starting to really also add to that portfolio.
Yeah, I need to look at what the German treasury rate is these days, but I know the US 1 year is over 5%. That is very tough to pass up. Like that as a part of the portfolio mix, it's tough to 5% is not bad at all.
I think with leading indicators, falling off a cliff, and knowing this kind of dynamics of the economy, then you want to pick up on this right now, because that's the case. That's, again, if you understand that the lagging indicators are the ones that will top out the last, then bonds are a fantastic buy now. Here will it be the bottom. We buy it, I don't know, but it'll be a good buy in terms of, or a great buy in terms of if I look into 2 or 3 years out ahead.
Yeah, no, absolutely. Fantastic conversation, Henrik. Really, really appreciate your time. We'll have to have you back on in 3 months because things change pretty much on a
Okay.
daily basis here anyway. But 3 months seems to be a good time frame because lots has changed since our conversation in November. Appreciate the update. Where can people find more of you?
Well, yeah, we got the SebergReport.com where we have a live show. I had live shows on Sunday. We have that on Sundays at 5 p.m. CET, where I explain these dynamics of the market. And we do cross market analysis. So it's never just about one market. It's about all the markets in the world and the larger markets, and understanding where different asset groups are in comparison to each other, and then simply trying to draw up this bigger picture. And I think. And it's really down to the understanding of this leading, lagging, and coincident indicators. And this is what where I base a lot of my the theory, you could say, on terms of where the markets are heading.
Fantastic. Henrik, again, so much. Thank you so much for your time. Also, check out Henrik's Twitter feed, quite a lot going on there. And we'll be back with lots more. Thank you so much, Henrik. And
Thank you.
everybody else, thank you so much for tuning in. We hope you enjoyed this conversation of Soar Financially. I think lots of valuable information in here that you need to unpack for yourself. Where do you think things are headed? Is gold really hitting 1,200? Is it going to newer highs after that? You have to make up your mind on that. I think there are some valid reason and some really, really valid points why it would be going much, much lower at this point. Go check it out for yourself. Our point is to create some really good, or provide you with some really, really good information. I think we were doing that, and Henrik has provided his views, obviously, on that. Make sure to follow our channel. Hit the like and subscribe button. I know 85 to 90% of you are not subscribed. It's that little square box at the bottom here. It says subscribe on it. Please do that. Thank you so much, and we'll be back with lots more.